The world's largest steelmaker today just told its workers, its managers, and practically everyone else to prepare for a downturn as bad as 2016 or maybe even 2008, 2009. Its chairman characterized it as a, quote, harsh winter, which, quote, will be colder, longer, and more difficult to endure than anyone expected. Understandably, steel prices have utterly plunged, and they've taken down key commodities like iron with them. Steel futures in China are down a quarter just since May to lows not seen since late 2016. And it's another one of these that's making severe comparisons. Iron has tumbled to its lowest price since November 2022. The harsh winter only starts with China, which just today reported more material weakness in all its major economic accounts like retail sales, industrial production, and fixed asset investment, along with, no surprise, another sharp drop in housing prices. Unfortunately, these commodities aren't falling because of only China. The world's largest non-Chinese steelmaker just downgraded its own forecast for consumption for the rest of the world apart from China, which is itself a key gauge of global economic circumstances. If people aren't building or making things with steel, it's because the economy is heading in the wrong direction. It's heading toward a winter, and maybe even if the Chinese guy is right, a harsh one. Well, the U.S. takes a break today from its own recession watch with a positive retail sales report for July, and I'll have more on that in this weekend's videos. Steel is reminding us that it is always globally synchronized, and steel prices have absolutely crashed here. In trading today, rebar futures in the Shanghai Exchange were down under 2,800 CNY per ton, which is the lowest since November of 2016. On July 16th, steel prices were up at 3,300 CNY, so down almost 16% just in a matter of a month. They had been as high as 3,600 back on May 22nd, which was the date we keep coming back to because that's right after the Chinese government announced its quote-unquote historic property rescue that has proven to be underwhelming in every possible sense. So steel prices are down 23% since that rescue was announced because obviously the steel industry isn't buying it, nor is anyone else around the rest of the Chinese economy. As I said in a recent video, the epic bond rally that the PBOC is desperate to get control over. According to one steel operator, steel mills at the moment have no intention to reduce steel production, partly as there are still thin margins, at least there were when this report came out last month, and partly due to anticipations of more stimulus policies coming from the third plenum to support the property and infrastructure sectors. And people were absolutely just fooling themselves, believing that Xi Jinping's government was going to come out with some massive bazooka. So you can see what was happening here in China. Demand was falling off, the property sector, the real economy has struggled, and yet steel producers and a lot of other industries as well were thinking, okay, it's weak here in China, but surely Beijing is going to come through with some master plan to turn everything around. So they kept running the steel mills, they kept running other factories and production capacity too, only for the third plenum, which was the last of the major political economic gatherings to take place, and the third plenum just came out with the same crap. There was no bazooka. There really isn't anything other than what China has offered so far, and everything that China has offered so far, none of it has worked. So now all of a sudden steel producers are like, uh-oh, what are we going to do? Well, they're going to dump a whole lot of their excess production on the rest of the world, in addition to preparing for the worst. And this is going to spread all around the world. This is not specifically a Chinese problem. It's going to spread immediately to all of those places downstream of China and its production capacities, whether it be steel or anything else. That's the reason why iron ore prices, for example, fell below $100 per ton. That's the lowest since November of 2022, simply because there's too much iron floating around there as well. If they're not going to be making more steel because steel is way oversupplied, that means deflation. That iron ore demand deficiency is going to go and hit places like Australia and Brazil and any other resource-heavy economy, because it's not just about steel and iron. According to Bloomberg just a couple days ago, on the supply side, Australian miners exported record tonnage through Port Hedland in June, smashing the previous peak at the world's largest bulk export terminal. In Brazil, producers set a record for shipments for the month of July. The countries are the two biggest exporters of iron, dominating the market. And that's going to turn around completely. The central bank in Australia, as well as Brazil, the central bank in Brazil too, they're both worried about inflation, red hot economy. The Reserve Bank of Australia is still concerned the economy's too strong. Well, give it a couple months here because the Chinese weakness is about to come flooding into Australian ports. And it's just where it's beginning. Steel is only where we can see it most visibly right now. And just what those big steel producers in China are seeing themselves, it's increasingly harsh. As the chairman of Baowu Steel has said, the world's largest producer, he called it a harsh winter and said for his employees and the company as a whole to start preserving cash. This is a time to survive, not worry about profitability. According to Bloomberg, the world's biggest steel producer sounded the alarm about an industry crisis in China that carries the potential to ripple around the globe and plunge the sector and a whole lot more into a deeper downturn. Conditions in China's steel sector are like a, quote, harsh winter that will be, quote, longer, colder, and more difficult to endure than we expected, China Baowu Steel Group Chairman Hu Wangming told staff at the company's half-year meeting, warning of a worse challenge than major traumas in 2008 and 2015. Eurodollar's number 1 and number 3, which were both really severe downturns for various parts in the world. 2008 was, of course, focused on Europe, the United States, and the developed world. In many ways, Eurodollar number 3, 2015 and 2016, was the emerging market world's equivalent of 2008, just without all the bank failures. But same dollar shortage, same economic catastrophe, all the same. Continuing. Global investors are lasered onto China's struggling economy, even as they contemplate the possibility of a recession in the U.S. with the Federal Reserve moving toward rate cuts that nobody actually cares about. They talk about rate cuts, but the big thing is about U.S. recession. But you have a U.S. recession at the same time China's going through a harsh winter. The harsh winter, the U.S. recession, it all gets combined into one globally synchronized whole. And that's why Chinese steel rebar futures are plummeting. That's why iron ore prices are down. That's why copper, up until today, had been exceptionally weak. Copper to gold down in the same comparisons that we're talking about here, like 2020, 2016, or late 2008 into early 2009. Harsh winter signals. Like I said, they're spreading throughout the rest of the world. This is not strictly a China problem. It's not strictly a steel problem either, but that's where it's really focused at the moment because it's easy to see all of this dysfunction, all of the oversupply in production, as well as the really deflationary consequences for the steel industry specifically. The Chinese are already dumping their excess steel production, which as prices continue to plunge, they're going to have to dump it even further on the rest of the market. And the deflationary impact of that is undercutting the production of other producers outside of China. They can't compete. They can't keep up. In fact, the prices are threatening to go so low, it's less than the cost of actually producing the steel. Just a couple days ago, ArcelorMittal, which used to be the largest steelmaker in the world, said exports from China had left the steel market in an, quote, unsustainable position as it reported its own drop in quarterly profit. Steelmakers in the US and Europe are being squeezed between a fresh wave of cheap imports and, here's the thing, anemic demand at home that's pushing prices lower. ArcelorMittal, the biggest producer among Western nations, cut its forecast for consumption outside China, a key barometer of the world economy. So China is exporting its deflationary overproduction to the West, and its steel is just the beginning. China itself just reported another weak batch of economic statistics, which just show that, first of all, the stimulus, quote unquote, that has been issued so far has had zero impact on the economy, the real estate market, anything. And number two, China's economic situation continues to get worse. Just when you think it is stabilizing and maybe even, as many in the West say, turning a corner, somehow the Chinese managed to put up even worse numbers than they did before, representing substantial deterioration, continued ongoing deterioration in the economy. China's steelmaker, the largest steelmaker, calls it a harsh winter, and we're just at the beginning of the harsh winter which is saying something given how far China has come already on this downward slope. According to the latest statistics for the month of July, industrial production, for example, that slowed down to 5.1% year over year, and it had been as high as 6.7% back in April when it looked like China was going to ramp up production in order to dump its products around the rest of the world. Now production is slowing down, at least the growth is slowing down because demand is slowing down inside of China as well as slowing down around the rest of the world. Even the market to dump excess production is itself shrinking. The 2-year change for industrial production is just 4.4%, which really shows just how weak the situation has become there, even with all of that excessive production. The monthly number was about 0.35%, which slowed from 0.45% in June. So even industrial production, which is the best of the Chinese statistics and where it's the best case for China's economy, isn't all that good to begin with. And that's before we got to what's happening and unfolding right now in August. Retail sales, which continues to be weak. Chinese consumers do not want to spend, and who can actually blame them? There's their biggest holding of household wealth, which is property, continues to fall. So retail sales, we'll get to the property numbers in just a moment. Retail sales came in at just 2.7% year over year in July, which was up from 2% last month, but there's really no difference. 2.7% is an atrocious figure, especially considering how retail sales and consumption have been so far behind the pre-pandemic trend to begin with. And there's no sign it's going to go anywhere close to going back to that. Continued weak spending from consumers. Retail sales actually managed to be positive on the month of July after being fractionally lower in June. Chinese retail sales are up a total of 0.75%. And that's 7 months of the year. 7 months so far, and retail sales are up 0.75%. That just goes to show how things have continued to weaken across the Chinese economy. Of course, fixed asset investment has slowed down. Now, this is reported as an accumulated year-to-date rate, which only makes it even more remarkable that it slowed this much. So the accumulated year-to-date year-over-year change was 3.6% in July. It had been 3.9% in June. So a 0.3 of a percentage point deceleration in a single month for an accumulated rate suggests strongly things are not going well in terms of fixed asset investment, which does include the property sector. And you can see that in the monthly totals. For the month of July, fixed asset investment was down again at 0.17%, but that was the third decline in the last 4 months and the fourth decline over the last 6 months going back to February. So despite all of the stimulus, lowering mortgage rates, aid to first-time home buyers, fiscal spending, ramping up spending through bond issuance and everything else, it's not having any impact in China, nor any spillover impact around the rest of the world. The most that you can say, jobs saved, is that the stimulus has allowed the Chinese system to at least pretend things are going to be going well, like I talked about in the quote from the steel mill manager, thinking that we're going to continue to produce steel and other things, hoping that the government will eventually bail us out, at least up until the third plenum. That's why a lot of things have changed since the middle of July. Because after the third plenum wrapped up and it was clear China isn't going to do anything different, everybody in China and around China went, uh-oh, what do we do now? Steel prices are plunging and so are a lot of commodities. And if you thought it was weak in the first half of the year, the winter's going to be very harsh from here. But finally, home prices in China. Home prices, no surprise, actually declined at a 4.9% year-over-year rate. That's accelerating to the downside from a 4.5% decline in the month of June. On the month, housing prices, the Chinese 70-city average, were down 0.7% for the third month in a row. And 0.7% is the fourth or fifth largest monthly decline in the entire series history. You've got 3 of them in a row. China's housing market, China's real estate, really having a bad time here. And of course, it's spilling over into everything else, starting with retail sales and consumption and going on into real estate development, which absolutely plunged yet again. According to the latest statistics, the sales of newly built commercial housing was just 541.49 million square meters, a year-on-year decrease of 18.6%. of which residential sales area decreased by 21.1%. The sales volume of newly built commercial housing was 533.3 billion yuan, a decrease of 24.3%, of which residential sales volume decreased by 25.9%. So with all of that, China's economy is clearly going to be struggling, but it's not just China. So steelmakers are going to be dumping their excess production even more than they have been, because what other choice do they have? And they're dumping their excess production at a time when the global economy itself is having a real struggle of its own. Recession in the United States, ongoing recession, and rolling over to further recession in Europe, in other places around the world as well. And it's not just steel. It's not just steel making. That's just the one that's most visible, because we can see steel prices crashing, reminding us that this is indeed a harsh winter for the global economy. The world's largest steelmaker just said it's going to prepare for a long, harsh winter in its industry because there's already a serious chill running through the entire global economy, not just China's. And in a related note, the utterly crazy and frankly alarming ways that the People's Bank of China is using not to stimulate the Chinese economy, but to derail the epic bond rally that's related to everything here, that's just crazy stuff that we talked about in the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. Until next time,